Are you ready to boost the most important aspect of your overall retirement planning? Do you know what it is? Stick around, folks. We will tell you, we will break it down. We want to boost your overall Social Security benefits. Welcome, everyone. Show's called Your Money or Wealth. Joey Anderson here, certified financial planner. And this show wouldn't be a show without the big man, Big Al Clopine.
Aloha, Joe. It's great to be back in Hawaii, and we're celebrating Annie's birthday today, so it's a great day.
Oh, well, happy birthday to Annie Clopine, Big Al's better half. You know, we're breaking things down today in regards to Social Security benefits, and it's probably one of the most important things that you have to look at because it could add hundreds of thousands of dollars to the bottom line. Most people make huge mistakes when it comes to claiming benefits because, right, hey, I turned 62 or hey, I retired, might as well start claiming it, start getting the checks in, but you might want to take a step back and do a little bit planning. That's today's Financial Focus. Wow, you're kidding me with the rocket booster there. I guess we are boosting your overall Social Security benefits. But it's important because if I look at this, 50% of couples, 50% of their income, right? If a married couple, if they're spending X, 50% of those discretionary income or fixed income sources have to come from Social Security. If you're unmarried, 70% of unmarried people, 50% of their income is coming from Social Security. And then if I look at here, 90%, 21% of married couples, right? Almost 100% of the income that they're living off of is their Social Security benefit. Unmarried, it's almost 50%. So for people that are single, married, it doesn't matter. This is truly important stuff here. Let's bring in the big man, Big Al Clopine, to break things down.
Today we're going to talk about boosting your benefits, making the most out of Social Security. So I guess the first thing is, how do you qualify? Let's get into the basics. What are your benefits going to be? And then we'll talk about delaying collection of Social Security to increase your benefits. We'll get into spousal strategies. And then finally, we'll get into taxation of Social Security because you do have a little bit of control over how much you pay in taxes.
I think the advice that advisors are giving their clients now, or if you look at any type of article on the internet, they're saying push it out as long as you can because we're living a lot longer and you get this 8% delayed retirement credit each year that you wait. You know, but if you look at reality, Al, still about 60% of individuals are still claiming, you know, full retirement age or younger. The majority of people are still claiming at age 62.
Yeah, and the benefits grow much more as you wait. And so we'll get into that, but I guess let's start with how do you qualify? So who is eligible for Social Security benefits? So first of all, you got to work 10 years in the Social Security system. And most jobs are in the system. A few government jobs are not, but most do. So the way that the Social Security Administration looks at it, they go by quarters, so 40 quarters or 10 years. The earliest age you can collect is age 62, and then in some cases, in all cases with spouses or survivors of eligible workers, you could claim based upon their benefit as well. So, Joe, it's, like we said, the majority of people will get some sort of Social Security benefit.
Yeah, I mean, the whole 10 years or 40 quarters is a little bit confusing as well. It's like, well, what actually constitute as a quarter? And it's basically, an earned income credit, if you will. And so I think in 2020, it's about $1,400. You get that credit for a quarter, or $1,400 or almost $1,500 in 2021 now. So it's not like you have to work a significant amount of time or make a ton of money to get that quarter.
Yeah, I think that's a good point, Joe. And I think probably the million-dollar question is, what am I going to get in Social Security benefits? So I guess the best way to figure that out, some of you, I think when you're 60 and older, you get statements each year. But many of us don't. And so you can actually go on the Social Security website, which is ssa.gov. You can actually sign up an online account and you can look at your statement at any time that you want. So it'll tell you what your benefits will be at various ages of collecting. And so the way that they do the calculation is they take your highest earnings over 35 years. And so for those of you that have worked less than 35 years, then some of those years will be factored in as zero. So the more years that you work and have wages, the higher the benefit's going to be. And Joe, they have a primary insurance amount where they sort of calculate how this is what your benefit's going to be.
Yeah, because it's inflated, right? Because what you were making 35 years ago and what you're making today is totally different, right, in regards to raw numbers. So they put an inflation factor on. So let's say you were making $30,000 30 years ago. That's probably equivalent of $130,000 today. So they cap us out, too, at a certain level. So you pay Social Security tax for your retirement benefit up to a certain level, and then you don't put it into the system anymore. And when you look at that, you're like, okay, well, what is my benefit going to be? Well, first, you want to check your record. So go to SSA.gov, look at your earnings record just to make sure that it's accurate. I know you have to go through records. It's 35 years of earning history, but then they use an inflation factor to find out what your primary insurance is. So you look at, all right, well, now I know what my benefit is. But what Social Security is meant to do, it's not meant to replace 100% of your income. You know, for lower wage earners, it was meant to replace a lot of those incomes. But as median incomes, large incomes, really large incomes, Social Security, depending on where you fall on the scale, is not going to replace 100% of the income. And here's a chart here, Al.
Yeah, and I think that's important to say, because you can see for the lower wage earners, they're not going to get full replacement, but maybe they'll get maybe up to half or even a little bit more. But then as you make more and more money, yes, you do get a higher benefit, but the amount of Social Security doesn't maintain it. And there's a reason for that. It's Social Security is meant to keep you out of poverty. So that's why it doesn't necessarily keep up. And Joe, I guess, when you get your Social Security statement, and you take a look at it, it gives you amounts that you're going to be collecting at various ages. Typically, they start with your full retirement age, and then they also talk about collecting early, which is age 62, and then also at age 70, which is later. And it's pretty interesting how different the amounts are. In other words, if you collect at age 62 an early amount, we got an example of someone would be collecting about $1,500. If they wait till full retirement age 160, and age 70, $2,700 plus. And so if you go from age 62 to age 70, you're increasing your benefit by about 80%. So it's a pretty big difference.
Yeah, it's almost a 100% increase in your overall benefit if you wait. But I understand, it's like, well, no, I need the cash flow now. But you want to do some planning here, because you're taking it at 62, just understand that you're receiving a lot lower benefit, and that's locked in for the rest of your life. So if you can wait, if you can find other means to cover your living expenses, because I think we all feel, hopefully, that we're going to live a long time. And so by waiting for that Social Security benefit, you're locking in a lot higher benefit for the rest of your life. And if you're married, and if you were to pass away prematurely, well, then the surviving spouse would also receive potentially that higher benefit. So there's a lot more planning to do in regards to collecting your benefit versus like, hey, I'm 62, let's go, push the button, and let's live happily ever after. Because it could not necessarily be happily ever after, because you could be living a lot more happy if you had a little bit more cash. So, hey, we got to take a quick break. Go to our website, yourmoneyyourwealth.com. We do have a Social Security handbook to walk you through all of the different strategies, how you're eligible, what it takes, and all the ins and outs. So go to yourmoneyyourwealth.com, click on our special offer. It's our Social Security handbook. We'll be right back. Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, alongside Big Al Clopine. Stick around this segment. We have Susan Brandeis, certified financial planner. She's our chief financial planning officer at Pure Financial Advisor, to break down some Social Security. But before we get to Susan, let's see how you did on the true-false question.
I don't have enough credits to claim Social Security at 70, so can I continue to work and claim Social Security at 73 when I have earned enough credits to collect? Joe, true or false?
I would say that's true. So if you did not have enough credits, and then at age 73 you have enough credits to earn a Social Security benefit, yeah, Absolutely. I don't see why not. That's a unique question. I don't think I've ever heard that. But yeah, as long as you have the credits, it doesn't necessarily matter what age, as long as you're over age 62. So let's switch gears a little bit. Let's bring in Susan Brandeis. Susan is a certified financial planner, director of financial planning at Pure Financial Advisor, and is also the chief financial planning officer. Very big title. Susan, welcome to the program.
Hi, Joe. It's great to be here.
Let's talk Social Security.
Let's talk Social Security.
Susan, we're talking about claiming strategies in regards to Social Security, and I think there's some confusion, or maybe, when should people claim? Because there's a lot of options that people have. They can claim as early as 62, or they could push it off all the way to age 70, or any year in between. But you look at the statistics, I still see that most people, almost half or over half, are claiming their benefit prior to their full retirement age. What are some of the reasons, do you believe, that they're doing that?
Yeah, so some of the reasons is one, let's just say they're not working and they want to have income. One way to turn it on is to turn on your Social Security. And a lot of people feel really comfortable having a paycheck or some sort of fixed income, so that's probably why too.
So that's a good point. So they feel the security of a paycheck that they have just depositing in their overall bank account versus maybe selling some other assets.
Yeah.
Selling their brokerage account or taking distributions from their retirement accounts. Hey, I don't want to touch that. Let's turn on Social Security. We'll got a baseline of income, and then we can kind of float with the other necessities.
Yeah, exactly.
What are some other reasons?
Also too, if you or your spouse have an impaired life expectancy, that could be another reason. If you don't think you're going to live past age 70 and Social Security benefits are at 62, you would want to take it as soon as possible.
Right, you wouldn't receive the overall benefit because there's kind of this break-even point, right? That people look at Social Security of, hey, not necessarily as a guaranteed income, but they're more or less looking at it as, hey, how can I get the most out of the system? And if I claim it at 62, it's bird in hand. If I wait till age 70, oh wow, a lot of things could happen. I could die before age 70, and I didn't get anything from the overall system, so then I would lose, right?
Yeah, exactly.
And then finally, what are some reasons that
and then the other one is if you don't trust the government, you just don't trust the government at all to honor their promised benefits. You're one of those people that have a conspiracy about the government, or you just think Social Security is going to get dried up, then you would want to take your Social Security benefits as soon as possible.
Sure, but I mean, there is true concern with this because if you look at the spending, the trust fund will evaporate at some point unless they make some significant changes. But let's just say that the Social Security is solvent. We believe that potentially pushing it out as long as you can to age 70 is the right answer. Why is that the right answer?
Well, one of the biggest things is when you delay your Social Security to age 70, you'll get the maximum benefits. And if you're looking for a paycheck, that means that you're going to get the biggest benefit for the rest of your life and your spouse's life.
So talk to me about spousal benefits. So let's say you have a married couple, one of them is pushing it out to get the maximum benefit. How does that affect the spouse?
How does it affect the spouse? Well, the spouse will get 50% of the spouse's full retirement age benefit.
So if I'm pushing my benefit out to, so I think some misconception is, if I push my benefit out to age 70, then if I was married, my spouse then believes that I would get half my benefit at my age 70 age. Is that true?
No, it's not true. If you push yours out till age 70, you'll get the maximum benefit, and your spouse will get the benefit of 50% of what you would have gotten at your full retirement age.
How about if I claim at age 62, what would my spouse get?
So if your spouse waited till their full retirement age, they would get half of your full retirement age.
So if my spouse claimed benefits early and I claimed benefits early, it would be a reduction of the benefit.
It would be.
If I claim later and my spouse claims later, there's no increase in benefit. They're always going to get 50% of the benefit at my full retirement age, or vice versa if they claim at their full retirement age.
As long as they claim at their full retirement age.
This is clear as mud, isn't it?
Totally.
I mean, there's a lot of different rules here, Susan. Now let's wrap this up talking about, we talk about spousal benefit. How about survivor benefits? Now, how does that work when one spouse passes?
So your survivor benefit, so you're eligible for a survivor benefit if you've been married, or you had a former spouse that you were married for at least 10 years. Now, to be eligible for survivor benefits, you would need to be at least age 60, and the benefit would be 100% of your deceased spouse's benefit.
All right, so if I break this down, if I'm looking at survivor benefits, it might make sense for the higher age earner to push it out as long as they possibly can, because then they lock in this high benefit.
100%.
And then if I were to pass away, then my spouse would receive the higher benefit. It was higher than hers.
Yes.
So there's other things to consider, I guess. If you are married or had been married for 10 years, you can still claim on ex-spouses or still receive survivor benefits from an ex-spouse. Let's talk about that for a second.
So let's say you were married and you were married for at least 10 years or more and you're currently unmarried, then you're eligible for survivor benefits or spousal benefits.
So as long as I was married to someone for 10 years,
Yeah.
I'm still eligible for that ex-spouse's survivor benefit and spousal benefit as long as I don't remarry?
Yes.
I really appreciate you joining us today.
It was great to be here, Joe.
That's Susan Brandeis, certified financial planner. Hey, go to our website, yourmoneyyourwealth.com. Click on our special offer. That was a lot of stuff, a lot of information there. Confusing. I got confused. I think Susan got confused. We're all confused. That's why you got to go to our website, click on that special offer. It's called our Social Security Handbook, yourmoneyyourwealth.com. It's free of charge. It's our gift to you. We got to take a break. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joey Anderson, Big Al, talking about Social Security. Go to our website, yourmoneyyourwealth.com. Click on our Social Security Handbook. Social Security Handbook. Yourmoneyyourwealth.com. Special offer. That's our gift to you today. Let's see how y'all did on the true-false question.
I can stop my current benefits within the first year of claiming, pay back everything I collected interest-free, and restart my benefits at a higher rate based upon my current age. Joe, true or false?
That is true. I think that's a little known fact.
Most people don't know about it, and even if you do know about it, that can be painful to pay everything back when you've already spent it. So I'm not sure how many people actually do that. But if you realize that you claimed at the wrong time, then there is that do-over within the first year.
Yeah, in a lot of cases, it makes sense to do. You just have to do the math. But you're right. You could do the math all day long, but you're still going to have to cut a check back to the Social Security Administration. And I would imagine most of you would be like, no, forget about it. Let's just kind of keep going with it. So let's switch gears, Big Al. Let's go to your favorite topic.
Yeah, let's talk taxes, because Social Security, as many of you know, used to be tax-free. And then many years ago, a couple decades ago, they started taxing it. And they have this tiered system as to how much is taxed. And so there's this concept called provisional income. And provisional income is essentially your income, adjusted gross income, without Social Security, but then you add back in half of your Social Security. You also add in your interest, tax-free interest, and you get provisional income. Then you go to this chart here. And this chart shows that if you're single, and your provisional income is under $25,000, you don't pay any taxes on Social Security. For married, it's $32,000. As you can see, there's a 50% bracket and an 85% bracket. So, Joe, interestingly enough, if you can arrange your affairs somehow to have a lower provisional income, you pay less taxes on Social Security.
I mean, this is key. I mean, we look at your overall picture is key, right? When you're doing your own planning, you can't look at Social Security in a bubble. You can't look at your overall taxes in a bubble because they all kind of combine together. Tax diversification is critical. So how are you creating the income from your other assets is going to determine basically how much of your Social Security is going to be taxed. If you have a lot of money coming from Roth IRA distributions, that's not included in the provisional income calculation. If you're managing your taxable accounts in a way that you're tax loss harvesting and you're creating losses and gains and knocking those out by creating income at a tax-free rate, that's also not going to be included in your provisional income. So we've seen individuals and families that have a very high income that pay very little tax, if any, just because of how the planning that they set themselves up for when they do start claiming Social Security benefits, they know how Social Security is going to be taxed.
Yeah, and I think it's important to say, Joe, that many states don't tax Social Security either. In fact, currently it's 37 states out of 50 do not tax Social Security, California being one of them. But let's talk about how you can potentially reduce your provisional income so that less of your Social Security tax would be taxable. So one of the ways would be something called a qualified charitable distribution. And this is when you're over 70 and a half, actually now 72. You can do it at 70 and a half, but 72 is the required minimum distribution age. And so instead of having a required minimum distribution show up as income on page 1 of your 1040, you can actually send it directly to charity. Therefore, it doesn't show up as income. Joe, it doesn't affect your provisional income, and you could be in a lower bracket just from that strategy alone.
Yeah, QCDs are very useful in a lot of different areas, and I still think people underutilize them. Right, you're giving to charity, but you're still taking a required minimum distribution. That's showing up on your tax return and kind of jumbles things up. So if you understand how all of this coordinates together, it could save you quite a bit in taxes and still accomplish all your charitable giving, tax goals, and so on. So, we talked a little bit about tax loss harvesting, funding with Roth IRAs, and then Big Al, real estate. What do we do here?
I would say almost every real estate owner that I've talked to, and myself included, has some kind of deferred maintenance to do on their rental properties. And in a year when you're trying to create deductions, potentially you can do some of that deferred maintenance and potentially write it off as a maintenance expense and lower your rental income, your net rental income. If your total adjusted gross income is below $100,000, you can actually write off up to $25,000 of losses on rental real estate. So that's yet another way to reduce your adjusted gross income, which then reduces your provisional income.
That was a little stretch goal there. They're going to do that every year, Big Al?
Not every year, but the years where you need it, right?
Got it. Let's do this. Let's go to Ask the Experts.
Do I have to delay the full year of my Social Security benefits in order to get an increase in my check? This is from Layla in Mission Valley. That's a great question. I think that, at least the way I read the question, Layla, is you don't necessarily have to wait till year end. In other words, every month that you wait, you get a higher benefit. So you don't have to wait the full year to get a benefit for, like if you did it mid-year, that's better than claiming your benefit earlier in the year.
You know what's interesting about that question too, Al, is that let's say that Lila is still working, right? And she's already collected her Social Security benefit, right? In each month or quarter or year that she works, if those are higher earning years or quarters than previous ones, her Social Security benefit will continue to increase. Right? But then there's a caveat to that. If you are claiming your Social Security benefits early prior to your full retirement age and you're working, you could lose benefits. So it's kind of a double-edged sword. They're really encouraging people to push those benefits off as long as you possibly can. And if you are still working past your full retirement age and you're still claiming your benefits, those benefits will continue to increase. They will never decrease. So let's say if you're working a part-time job that has a lower earning than some other years, they're not going to decrease the benefit, but it will increase if you have higher years. So really good question. Let's go to the next one.
This is from Mary and Ramona. If I do a large Roth conversion this year, I'll be able to significantly reduce my taxes in the future. However, it will put me in a higher bracket for Medicare premiums. Should I do the Roth conversion or not? That's a great question, Mary. And I guess the point is, when you do a Roth conversion, you're adding income to your taxes. You're going to add income to adjusted gross income, pay higher taxes in that current year, which then with Medicare premiums, when you're subject to Medicare, usually 65 years and older, then there's a 2-year look back. So if you had a high income year, by doing a Roth conversion, 2 years later, you may be paying higher Medicare premiums. So I think the way I would think about it is you'd look at the extra Medicare premiums that you would have to pay 2 years from now and just add that in as an additional tax, if you will. And does it still make sense to do the conversion? I think that's the math that you have to do.
You add that additional cost into the tax, and then you find out what the effective tax rate is, and then you look in the future to see what effective tax rate you're going to be. If you're still going to be in a higher tax rate or the same, in the future it probably makes sense to do it. If not, I mean, that will give you a good gauge. Let's see what we learned today. First off, you really want to take a look at how do you maximize the benefit, right? This is a pension. that you will receive for the rest of your life. So you want to make sure that you maximize the benefit as much as you can. Looking at delaying. Some of you can't delay the benefit, and that's okay. But for most of us, maybe it might make sense maybe to delay a year or two and find other sources of income, either through your portfolio, part-time work, or whatever, just to lock in that higher benefit amount. And then if you're married, or if you have a spouse that you're married to for at least 10 years, there's claiming strategies that you should be aware of. And finally, making sure that you reduce your overall tax bill. Hey, if you want more information on this, you know where to go. Go to yourmoneyyourwealth.com. Click on that special offer. It's our Social Security handbook. Yourmoneyyourwealth.com. Click on the special offer. Yourmoneyyourwealth.com. It's our Social Security handbook. That's it for us today. Big Al, have fun in Hawaii, my friend. You're looking good.
I sure will. I mean, it's great here.
Yeah. Are we on a 7-second delay?
Were we?
I don't know. It looks like you are. I'm done speaking, and you're like, yeah, I will.
Yeah.